and welcome to this episode of Get Started in the Market. Thank you for following our series so closely. In the last episode, we brought to you an in-depth tutorial to help you understand the financials of a particular company, to help you understand the current and the future growth potential of a particular company. But is that enough to help you choose the right stocks for yourself? Okay, just imagine that you wanted to buy a bike. Here I am standing in the middle of two bikes of two of the most popular brands in the country. One is a Hero and one is a Bajaj. If you have to make a decision to choose the one right bike for yourself, you look at various factors like its price, its style, how it looks, mileage, durability, and many other factors like this. Similarly, if you are looking to choose the right stock for yourself, you look at relative valuation ratios. Well, that might sound complicated, but actually it's not. Let's now understand what these ratios are.
Ratio analysis gives a quick indication of a firm's financial performance in several key areas. Financial ratios are categorized according to the financial aspect of the business which the ratio measures. These ratios can help us draw comparisons between companies or industries, or between different time periods of the same company, or even a single company compared to its industry average.
A ratio, in simple terms, is a relationship between two quantities. Consider this. Here in this particular basket, we've got 5 oranges and 3 apples. If these 5 oranges are benchmarked to these 3 apples, then the ratio is 5:3. For example, these apples were not there and there were just 5 oranges. It does not make any ratio. It simply means that these are 5 oranges. And hence, any financial ratio, if that is being used to analyze a company's performance, then it cannot be used single-handedly. That financial ratio has to be linked, has to be benchmarked to the past performance of the company or probably to another company. At the same time, just consider if we have an apple and an orange with us, and if I'm trying to compare an apple saying that this is crispy, can I compare it to an orange? No, I can't, because an orange cannot really be crispy, and hence to be able to get a better comparison, we have to compare apples with apples. To understand it simply, if you are considering any financial ratio of any particular company to choose a particular stock for yourself, you have to firstly understand that the companies that you are comparing that particular company with, they belong to the same industry, they have got a similar risk profile. You have to look at various other aspects as well. Then only you will be able to compare apple with apples and oranges with oranges.
So let's understand some of these ratios and what they stand for. First and foremost, you should understand what is EPS, or earnings per share. EPS is calculated by dividing the net income of a company by the number of shares issued, which takes us to price to earnings, or a PE, which is one of the most widely used ratio in the financial world. It indicates the market price of a share in terms of earnings, or simply put, it is the rupee amount an investor has to pay for each rupee of earnings made by the company for the ordinary shareholder.
So PE is in some sense the most used average. It gives a kind of number of years that earnings will take to equate to the current price. It gives a sense of cheapness or expensiveness in the market. So in some sense is an very useful number to start with, but obviously one has to use this number in conjunction with a few more variables, and then the power that this variable can be used for can be really expanded. So, for example, if this number is used in conjunction with the growth outlook of a business, that would help. And then if it is also used in conjunction with the quality of business with a parameter like return on capital employed, then the power of the number would expand considerably.
Before we move on to the next ratio, let's first learn how to calculate the book value. The book value per share is calculated by dividing the total shareholder equity by the number of ordinary shares outstanding. In simple terms, it would be the amount of money that a shareholder would get if a company were to liquidate. Price to book value, or P by BV, is a ratio that indicates the market price of a share in terms of the book value of equity. It is the rupee amount an investor has to pay for each rupee of book value.
Price to book multiple is a measure that helps us usefully value the equity portion, the equity investment that we do, because the traditional net profit margin at times doesn't tell you what the company's valuation is. So what is net profit? Net profit upon sales gives you the net profit margin, but if you take, instead of the sales, take the equity which is into the denominator, you get a return on equity kind of number, and that's a useful measure for you to help you value the company. So on ROE, which is, let's say, higher than the risk-free rate of return, will tell you that you need to look at the price to book value component and any number in multiple of that risk-free return. So if a risk-free return is 7%, your equity should be valued, and your ROE is higher than 7%, then your equity should be valued higher than the book value. So the price to book value essentially gives you a fair degree of measure vis-a-vis the return on equity that you are generating.
Price to sales valuation ratio compares a company's stock price to its revenues, and it indicates the value placed on each rupee of a company's sales or revenues. It is calculated by dividing the company's market capitalization by its total sales, or on a per share basis by dividing the stock price by sales per share.
Well, it's important because these are the key dominants, the top line and the bottom line. The company has to show growth on its top line or its sales for the investor to invest in it. Reason being, he wants to see what the future projections are. And that number is generally not fudged, it's clear, it's a transparent number, it indicates what your volume growth has been. The bottom line could be, a little bit because of depreciation and interest, you could change the numbers. But the top line is unique, and it tells you what the investor or the retail investor is ready to pay when he's seeing sales growth of your commodity or your product.
Return on equity, or ROE, measures a company's profitability by showing how much profit a company generates with the money that shareholders have invested, and is calculated by dividing the net income of a company with its total shareholder equity, and is expressed in percentage terms. Higher the return on equity, the better it is. The companies with a higher return on equity are looked at as efficient.
I think that essentially binds the valuation to the balance sheet. So ROA essentially looks at return that a particular company gets with respect to the overall capital that is deployed, which includes debt and equity capital. So effectively, it does tell us what is the efficiency of utilization of capital that a particular company is doing or a particular sector is doing. Of course, these are different for different sectors. There are some capital intensive sectors which typically have lower ROAs. And there are sectors, let's say, which are more service oriented, where the capital deployment is somewhat lesser. Or the business growth is, the operating leverage is higher. There the ROE is higher. So that's important from a valuation standpoint. So price to PE ratio that we talked about earlier basically looks at the P&L and the valuation. The ROA context essentially looks at the balance sheet.
The last valuation ratio on our list actually helps in determining the value of a company, and is also called the enterprise multiple of a company. It is calculated by dividing the enterprise value of a company with its EBITDA. The enterprise value is arrived at by adding the total market cap of the company with debt and preferred shares and subtracting the cash on its balance sheet. This ratio is used extensively to compare businesses across countries, as it does not take into account the taxes paid, which might differ across countries. Also, this ratio takes into account the debt of a company in its enterprise value, giving a more realistic picture of the value of the business. This ratio is used extensively during takeover decisions.
EV by EBITDA ratio is very important for one, stable industries by and large, because that is where the capex cycle is over and most companies in industry can be compared. So it's not a good index when you look at things like biotech sector, pharma sector, where there is substantial development cost. Now, when you're taking over companies, you're obviously taking over both the equity portion, buying out equity, and the debt, which is why we use the multiple of EV to EBITDA to say how many years it will take us to kind of pay out for this investment. And that's a critical feature. But standalone, it makes no sense because it is linked to what is the capex that we are incurring and what the company is incurring, and which has not been put to commercial use, because that needs to be discounted. Once you discount that, then that's a good measure to use for any takeover that you propose.
But are all these ratios equally relevant when analyzing companies in different sectors? Is price to book value, or PBV, as important to look at while comparing manufacturing companies as it is while comparing banks? Will price to sales give the right picture when you're comparing different technology companies? We find out the answers to these questions in our next segment, so keep watching.